Hello, everyone, and good morning. Welcome to Saxo's weekly market outlook call, the Saxo Spotlight, as we call it. I'm Charu Chanana. I'm a market strategist with Saxo's Singapore office, and I'm joined today by my colleague Redmond Wong from Saxo's Hong Kong office. So let's dive right in. What a week it has been, and the weekend as well. In fact, if you can see our slides, I believe. Redmond, can you help to share the slides again, please? Yeah,
Yep.
okay, I can see it now. Yeah. So if you, we'll just dive straight in and look at those massive weekly changes in the week that we saw. We had 2-year yields down 75 basis points as a result of the fears of a banking crisis. And it's actually not been all down days. One day is 60 basis points down, the other day was 30 basis points up, and just a very, very volatile week. But that overall decline in yields is what got that tech-heavy NASDAQ to outperform, as you can see here, up almost 6%. Big moves in commodities too. Oil down over 10% because of demand concerns, and then gold, which is obviously considered as a safe haven, up about 6.5%. So just some very, very massive moves. And, we all know what happened. It started with the bank run on SVB, a US bank, in the previous week. But the US authorities did step in to save the day. Then that was really followed by a scare on Credit Suisse, which again saw Swiss authorities stepping in to broker a deal with UBS last night. But the deal actually happened at a 60% discount and has completely vaporized the additional tier 1 bond. So what that means is that the value of some of those bonds has actually gone down completely to zero. Those bondholders will not be compensated at all. While overall, the fact that Credit Suisse has been saved from a collapse is helping to build up confidence in the short term. We do think that this could mean a broad derating or a repricing in the corporate bond market. So I think long term, there are still a lot of uncertainties within the US as well as the European banking sectors. Redmond, maybe you want to step in and share what you make of what's happening in the banking space?
Yes, thanks, Charu. Yes, and I think this morning, as you mentioned, the biggest news, of course, is the deal between Credit Suisse and UBS. And UBS agreed to pay 3 billion Swiss franc and to take over Credit Suisse. That's under the condition that the Swiss government is providing 9 billion to backstop some of the losses that it might incur to UBS from this deal. And also the Swiss National Bank is also providing a huge amount, $100 billion liquidity to facilitate the completion of the deal. So initially that is as good, and so they managed to get a deal. And before Asia opened this morning, the one of the things though in this deal, one of the potential risk is the deal will actually wipe out, as Charu mentioned, about that 16 billion Swiss franc or 17.3 billion US dollar worth of alternative tier 1. And a lot of time we call them is those COCO bond, contingent convertible bond, and which are subordinated and also have loss absorption cost, and also can be wiped out to zero under some condition of restructuring. And this time, the Swiss regulators allow that the deal to trigger those terms and to wipe out. And that is with the impact on it. I think we will know more when London open, when the credit market become more liquid. Having said that, in fact, some of the bond desks actually is have been open throughout the weekend to trade on Credit Suisse debt. But anyway, but that it will go beyond about the debt of Credit Suisse, because as Charu mentioned, that will actually cause a repricing. And what it means by repricing, it means it will not just affect that 280 billion worth of cocoa bond outstanding, or from banks. Those were issued after the Great Financial Crisis as a measure to boost up tier one capital of bank, and that will also may have a negative impact on many of those other subordinated debt, even though they are not cocoa, even though they do not have loss of subsequent cost, but many of those subordinated debt might be negatively impacted, especially some of those bank perpetuals and so on. So with that is remain to be seen, and so that will have a negative, that may tend to have a negative impact on risk asset, including and stock. So that we have the tailwind helping the stock market by getting a deal done, avoiding a bankruptcy of a major systemic important bank. But we also have the headwind against credit, and if credit was widened, more difficult to borrow money, and that will also have negative impact on the economy, and also would be bad for stock market, and also create volatility. I think we advise our clients to be cautious and to monitor the two risk. So it's not just positive news, but there actually has bad and negative news also contained in this deal. And also the Fed is extending dollar swap line to on a daily basis. And why do they need to do that? Because it's when the credit market is squeezed, and a lot of the borrower, they have debt in dollar and outside the U.S. and they need dollar. They go to the central bank, and the central bank need dollar and from the Fed. So the Fed we are doing swap and to providing more dollar to help to reduce the strength, the tightness in dollar liquidities outside the U.S. So that may under this situation is one thing before on the bank, we also want to talk a little bit about the U.S. banking situation. I mean, one of the in the deal the Fed did the week ago, the most important is actually that facility to lend against collateral of U.S. Treasury and mortgage-backed securities at their face value. So, i.e., if a bank they have some bonds in the held-to-maturity portfolio, and face value is 100, and even though the market price came down to 70, they can still get financing at 100 from the Fed for up to a year, and for at least a year. So that is actually help to reduce, remove some of the risk from the system, and that is actually we see some stabilization there in the U.S. Regional banking, even though there are still some deposit flight into the larger bank, but overall the problem seems at the moment is contained. But having said that, we also seeing quite the discount window being used quite a lot, and the discount window, actually the jump discount window borrowings more than 140 billion last week, and to 150 something billion, and that was actually much higher than the 111 billion we saw in the 2008 financial crisis. So that's quite a lot of usage from bank to go to the Federal Reserve to tap into the discount window to borrow. But so far, if you look at the performance of the regional bank index, and so last week it's down more than 14%, but it's still tend to be I can see it here, and but this tend to be stabilizing. And but one of the noted development in the U.S. equity market, and the Nasdaq did very well, especially some of the large cap in the consumer communication services and information technology. And you see in this chart, you can see Alphabet, Microsoft, Amazon, they have gone up more than 10% over the last 5 days, and while banks are the ones suffering. So I think these large cap are benefiting from lower interest rate. And talking about lower interest rate, yes, Charu mentioned they down 75 basis points in the 2 year, the biggest move we saw there. And I think I want to show you this chart is put it into more perspective and visualize it. And the drop is very sharp, but if the Fed really pause, and if those credit market continue to dry up, and because of It's and that will that the 2 years still looks a good buy for safe haven because of the safe haven demand, and so I think investors will still. Especially given the wiping out of the cocoa bond, I think the investor probably will still like to, even though this morning in Asia, you jump a bit about 10 basis points in the 2 year, but I think when the market settle down a bit, we assess the situation, look at the risk on the credit, and they might probably power back in to the 2 year. And also it looks maybe the initial buying the equity may be short-lived, so I think we need to be cautious there. I think I stop here and I pass it back to you, Charu.
So yes, absolutely. I mean, this morning we are seeing a little bit of risk coming back on the table, but I think our sense really here is that the uncertainties ahead will continue to keep the markets extremely volatile. It is now clear that the rapid Fed tightening cycle has probably broken something. The measures by the authorities, both in the US as well as in Europe last night, they have probably saved the day, but not the weeks or the month or the year ahead. So I think that's something we need to keep on our radar. I think for this week, we continue to watch the credit metrics, keep an eye out on credit default swaps of some of the other banks that could come into a lot of focus. Keep an eye out on credit ratings from the rating agencies. So last week we saw a list of downgrades in outlook for US banks. If more such downgrades in outlook or the actual rating itself were to come, we could see the sentiment being hit further in terms of the banking sector crisis. And then it's not just all about the banking sector. This actually coming week is going to be quite important because we also have the Fed announcement on Wednesday, followed by the SNB and the Bank of England meetings on Thursday. So that's obviously going to be very important as well. The ECB last week may have set a little bit of a precedent by sticking to guidance script of a 50 basis points hike. So for the Fed, it's been quite a roller coaster, right? I mean, markets priced in a higher probability of a 50 basis points rate hike after that very hot January data on inflation, on retail sales, and after Powell's testimony. But this banking turmoil has really changed things around once again, and now not even a full pricing of 25 basis points is being seen. Many are calling for a pause. Some are actually also calling for a rate cut. So Saxo's view here is that the Fed has addressed the banking risks by providing backstop funding broadly to the sector, as Redmond just mentioned. It may not be a great fix in the long run, but it is what was really needed to stem panic and avoid a contagion as of now. So this has been a step towards keeping the financial risks and monetary policy decoupled, as inflation is still quite high. Last week, we had the core CPI come in still at about 6%. So unless we see any further market disorders, our sense is really that the Fed can still go for a 25 basis points rate hike. But of course, I mean, it's going to be extremely volatile. It's still contingent on what happens between today and Wednesday. If things deteriorate in the banking sector or more generally for the markets as well, the Fed may also be forced to a pause. Moving on, I think in the interest of time, I'll just touch some of the other items of this week very briefly. We have Japan's CPI due at the end of the week, and that will be again important, because wage pressures are picking up. The wage negotiations last week resulted in setting a wage growth of 3.8%. So that is quite key. It's the highest in 30 years that they've seen in Japan, and that could continue to mean that even though the market is not pressuring the incoming BOJ Governor Ueda to immediately alter that massive easing policy in Japan, I think in some way or the other, inflation will continue to create that pressure. And my sense here is that if Ueda was to alter the yield curve control, it has to come not from the market pressure, it has to come from the inflation pressures. So this inflation print again remains important to keep those expectations of some tweaks in BOJ policy alive. And on top of that, of course, yen is acting as a safe haven amid all these global contagion concerns in the financial markets. So I think that still provides room for some more yen strength. And the other macro of note this week will be the UK CPI and the Bank of England meeting. As I said earlier, I think inflation in UK is still expected to be around 10%. And the BOE, much like the Fed, I think they can still go for a 25 basis points if risks remain contained. But more important will be whether they signal a pause. So again, what we think really is that the central banks, which are above neutral, so say, for example, the RBA, the RBNZ, Bank of England, Bank of Canada has already signaled a pause. All of these could now start to signal, pause in their tightening cycles, with the financial concerns really taking a leap forward in the last week or so. But the Fed possibly still has some more room to, continue to hike as long as things don't get out of hand, like I said earlier. Redmond, over to you on China, and what else are you watching in this week? You're muted, Redmond.
Sorry about that. Yeah, just before going, talking about China, just one thing I forgot to mention earlier about the equity market. I think that's worthwhile to mention is, instead of looking, I think the market focus, because of the Fed's aggressive move to basically backstop all those is a held to maturity, treasury, and MBS portfolio. So the risk actually, that avoid any systemic risk. I have to emphasize that the systemic risk in the regional banking system has been avoided, at least I think for the time being. And also is the focus for the short seller in the market actually move away from those banks holding a lot of treasury. But actually, we heard from trading desk, actually the short interest is more related to bank or hedge fund exposed to commercial real estate, and also the office REIT and so on, under selling pressure and short selling pressure. And that remind me about I think on March 8th, I think Blackstone also has a CMBS fund default to creditors. So be careful about any commercial real estate exposure for in the fund side and also in the bank side. I think that's something I want to add about the global market. And then back to China. And I think the thing last Friday after market close, the PBOC cut the reserve requirement ratio by 25 basis points, and that is a smaller, small cut. Over the last 3 times is they cut 25, but before 2022, in the past, they usually move by 50 to 100 basis points and as much as 300 basis points. So the last 3 moves, 25 basis points, including this one, is kind of modest. And also there's some market chatter about whether they will cut the long prime rate. They did not. This morning, just when we are speaking, it's confirmed that they didn't. That the long prime rate remain unchanged this morning in the fixing among the by the major commercial bank in China. And I think is so that may not the triple R cut will not give much excitement to the market. So the market is still watching more. I think maybe on the earning, and because we have Pinduoduo and today after market close, and also we have Tencent on Wednesday and Meituan on Friday. I think the important thing is now after the reopening, investors are watching very closely whether there was pent-up demand or recovery in consumer spending, whether they will materialize. So far, expectation on the revenue growth on Pinduoduo has been pretty good. It's over 50% kind of revenue growth year on year, and also have for net profit expecting to up 46% year on year in Pinduoduo. And Tencent revenue probably not so much change, but profit is expecting is adjusted net income is market is expecting a more than 20% increase. And Meituan and the market consensus is also expecting some strong demand growth in their food delivery business, and even despite the COVID disruption. So let's see, and they will actually give some better idea and may set the tune for the China and Hong Kong market. going forward in the coming days. And also in the US, we also have Nike and also General Mills, and that will also tell us a bit about especially Nike will tell us about the strength of the global consumer, and whether especially important is the outlook and whether they are seeing deceleration or not. So I think that would be the focus this week. And Charu, back to you.
Okay, I think let's just summarize here, wrapping up everything we discussed today. And we will also be publishing a note on that, Saxo Spotlight, which will talk about what to watch this week, and we'll also include a recording of this webinar. So basically, I think our sense here is that investors are taking risk off the table. So if you want to do that, Saxo provides options to keep cash and also earn interest on it. We also have a range of fixed income products on our platform for you to explore. Perhaps, like Redmond mentioned, short-term government bonds could still be interesting, with corporate bonds likely to get hit because of this Credit Suisse deal that we've seen overnight. Consider, of course, safe havens like gold and the Japanese yen, although I'd warn that gold has probably had a great run already. So if you're looking to add exposure, it might be prudent to wait for some retreat or for some consolidation there. But yen, I think, has seen more orderly gains, and those can potentially still continue from here. And lastly, in equities, even though lower yields do mean that equity valuations can go up, but risk premium is on the rise as well. So flight to quality is really key. And what is quality? Quality is, of course, stocks that have strong margins, they have a good pricing power, good earnings and cash flow, and most importantly, the debt is more manageable. Also on the next slide, Redmond, we will be discussing all this and more further in our webinar this week on Thursday. So you can sign up for that if you're interested. The sign up page is available on our website. It's available on the platform as well. And I think that's it from us here today. Anything else you wanted to add, Redmond?
I think we can stop here and wish our audience a good week of trading.
Yeah. Stay safe out there. Okay. Have a good week, everyone. Bye-bye.
Bye-bye.